You have already seen this picture. This is the illustration of the competitive firm which finds that at the optimal possible quantity it has losses. Now, what shall this firm do? If firm has negative profit, if it has losses, then it's better to be shut. It's better to have nothing. No production, no firm, zero profit, right? So, in fact, the natural idea for this firm would be to leave the industry. This decision to leave the industry is called exit decision. However, there is another way of thinking of this. If we start to think in rather short run, in the short period, recall that the cost of the firm have two components: fixed costs, which you pay independent on how many units of output you produce, and the variable cost. Fixed cost, imagine that these fixed costs are, for example, the cost of renting the place or something like this. So this fixed cost usually has already been paid, at least in the short run. So in particular, think about some coffee kiosk, and there the owner already paid or had a contract to pay for the leasing the place on the monthly basis. And then on the second week of this month it discovers that the profits are negative. In this case, we call fixed cost sunk cost. So sunk cost is the idea that this cost should not be taken into account. In fact, they have not to be taken into account because they already paid. So now in the short run, firm actually do not have to look at all costs. What it can do in the short run then, it can thinking about being or not being closed temporarily. And that means that in the short run, the firm faces another type of decision. It's called shutdown decision. So the difference between exit and shutdown is that exit is permanent and shutdown is temporarily. Okay, so when you have a shutdown decision, you still have a firm, but you have no production, and in terms of the firm, it means that it has no variable cost. It doesn't have to pay anything. Okay, so I think that this example with coffee should be clear, but another example can be, for example, use of land for production of crops. In the short run, the land, even if, for example, belongs to the farmer, then of course it is considered as being opportunity cost. It cannot be sold immediately. So in any case, this land is there, and so the cost of the land becomes sunk cost in the short run. Let us think about these two decisions. Let us start with the long run decisions. So, of course, these decisions happen when the prices are low. When the prices are low, then the firm faces possibility to have a negative profit. For example, if you look here at price P1, quantity is Q1, and firm makes profit because the quantity is bigger than average total costs. The same at P2. But what if price P now falls? Okay, so at which moment firm should exit? This is the long run decision, and so the firm actually looks on both fixed cost and variable cost. So two alternatives for the firm are this. One alternative is to continue to produce and have the revenue which it gets and pay cost which it gets, or it may exit and then have no fixed cost and no variable cost. So you should understand then that what actually the owner of the firm think of, it compares the optimal revenue, the current revenue, so the firm is operating on the best possible scenario, so this is the current revenue, with the total cost. And if you rewrite this inequality, so this is actually the condition for exit. When the revenue is less than total cost, that means that the profit is negative. If you rewrite this inequality in terms of averages, you have average revenue less than average total cost, and since average revenue is price in the competitive market, price is less than average total cost. So we now conclude the following. When the firm considers this for the long run and can actually get rid of the fixed costs, it will exit at the moment when price is less than average total cost. This is the point, minimum of average total cost, of the decision to exit. For the short run, the situation is a little bit different because, as we explained, in the short run, fixed costs are sunk costs, so they do not matter for the decision. So what firm then should do, it should only care about variable cost, and it will shut down when price cannot cover the average variable cost. How to show that? Look in the last line. So, oops, sorry. In the last line, you see that what firms in the short run does it compares the revenue with variable cost. Then you take the averages, average revenue and average variable cost should be compared. And so if revenue is less than variable cost, it means that price is less than average variable cost. That is when firm would be better off by stopping to produce anything, that is getting rid of both revenue and variable cost. Okay, so this is the conditions which you as an owner should understand. So if you are facing this decision in the short run, that is, you know that the fixed cost cannot be recovered, the only thing which you can do is to shut down. But then you think, do I have to do or not? And you compare price with average variable cost. Essentially, for all the prices above then the minimum average cost, you would not shut down. But for all the prices below, you would shut down, because then at least you don't have to pay the variable cost. Restaurant owner may close the restaurant, or coffee owner may close this cafe. It's still there, so the rent is being paid, but the variable costs such as the wage for the personnel are not paid. So that's the shutdown decision. If you are in the long run, you have a possibility to exit, that is to get rid of all the cost, and you exit as soon as price is below than this point. That leads to the two types of supply curves. In the short run, and here the short run is exactly explained in the sense that some inputs cannot be changed, such as capital cannot be changed. The firm cannot get rid of the land, cannot get rid of the production facilities. In the short run, the decision is shut down when price is less than average variable cost. So for any price which is below than this point, firm would not produce, and it means that it would have quantity 0. But at this moment it starts to produce, and it moves along the marginal cost curve as we established in the previous chunk of these videos. In the long run, everything depends on the minimum of average total cost. And so now the firm exits when it is less than this point, and it operates on the marginal cost and this regime. So short run supply curve of a firm is the red curve here, and in the long run is this red curve over here. Notice the difference. There is a small region somewhere over here where there is between minimum of average total cost and average variable cost, where the firm in the long run would like to exit, but in the short run it would prefer, it's in the interest of the firm, still continue to produce. Why? Because it can still, from the revenue, cover the variable cost. And what you may think of this is also, sometimes, you know, the firm is facing these prices are changing, so market conditions may be changed. If price suddenly gets lower, and we are in this situation, in the short run, firm may still be running, and in the while in the long run, it would be closed.